So what's the real truth about the housing bubble of 2021? I'm Shelley with the Holz Group at Keller Williams, and we get asked that question all day, every day, and I am going to answer it for you today. So the first thing we're going to address about today's housing bubble is that it's not a bubble at all. So if it's not a market bubble like what we experienced in 2008, what exactly is it? And here's the key difference. In 2021, what we're experiencing today is it's a market of extremes, not a housing bubble. Now, a housing bubble and a market bubble is not sustainable, just like a market of extremes isn't as well. So we're going to explain the two fundamental differences on what is unique about this market in 2021 versus what we may have experienced in 2008. So the two main differences between the 2008 housing bubble and the 2021 market of extremes comes down to one, the cause, and two, the effect. So let's start with what's causing this in 2021 versus what caused the 2008 housing bubble. Well, the 2008 housing bubble was really started in the mortgage industry. There was a lot of greed and push to create more mortgage approvals for people who should not have been approved for mortgages to begin with. There was a lot of subprime approvals, and that caused people to get approved for homes that should not have been approved for the level or the amount that they were approved for. That was the cause of the 2008 housing bubble. Now, the 2021 market of extremes is caused by something completely different. And this cause of today's market is increased demand. So you might be asking, what's causing the increase in demand? Well, there are two things causing it in today's market. One is an increase in demand because of historically low interest rates. Never before had we seen interest rates this low. And interest rates is the number one thing that increases affordability with home buyers. So the more they can afford at the lower rate locked in, the more buyers that we have out in the market wanting to take advantage of the market opportunity. The second thing that's causing the unprecedented demand in today's market is low inventory. Now, we get asked a lot, what is causing the lower inventory? And here's the thing, during the 2008 housing market and the recovery that we had to go through during that time, home builders really slowed down and some all out stopped home building. Either they went out of business because they went bankrupt or they slowed way down because the demand wasn't there. So in essence, we're trying to catch up on years and years of slow and little new construction and new home starts in the market. And that is causing us to try to catch up from past time. So if you remember, I said there are two fundamental differences between the market bubble of 2008 and the market extreme of today's market. So let's dive into the second fundamental difference, and that's the effect. Now, the effect of the market bubble of 2008 caused a pop. The market popped because buyers were pushed into mortgages and home ownership that they couldn't afford. Now, market extremes don't pop, they correct. So this is going to be a huge difference in what we're anticipating and what we're seeing in today's market. So when we go back to the pop of the market effect from 2008, if you recall what happened, mortgages started going into default and homeowners went into default with their bank, causing foreclosures and short sales in the market. Those increase in short sales and foreclosures had a downward effect on home values, and the slide continued for a number of years. That's the effect of a market bubble that pops. Now, a market correction for 2021 is going to all be market driven. See, here's what's happening in today's housing market. Is the increased demand that we're seeing is organically happening in the market because markets are driven up naturally by home buyers who want to buy and home sellers who want to sell. And market values are driven by What is a buyer willing to buy and what is a seller willing to sell for in the market conditions of that time? And that's what we're experiencing today. With extreme demand and lower supply, we're just seeing the natural laws of economics play out. And when you have extreme demand with lower supply, naturally you're going to see home prices rise. And that's all market driven, which means it's just today's market value. The second thing that will contribute to today's market correction that we're anticipating in the future is interest rates. Now, I'm sure you've all heard that they're historically low. And really, that means the only way they can go is up. And economists are anticipating that in the future. So here's the thing to know about interest rates as it affects affordability. Just a 1% increase in interest rates actually creates a decrease by 10% in affordability. That 10% means tens of thousands to what a home buyer can afford. And if a home buyer is going to afford tens of thousands of less of home benefits and amenities, well, you just can see that will naturally decrease demand in the market. And when there's a decrease in demand in the market, that will naturally create a market correction and what we're anticipating in the future. Now, that is a market correction, not a market pop. Again, the fundamental difference between now versus 2008. So if you're thinking about making a move or even just want to talk through the impact of today's market and what we anticipate at the Holz Group is going to be the market of the future, contact us today. We'd be honored to start the conversation and just strategize about your situation. Call us at 651-998-9829. We look forward to hearing from you.